Blog Talk Radio.
Good afternoon, everyone. Welcome to the Hollis Chapman Show. Hey, we have a special guest here today. He's here to promote his new book. He's in the financial business. And right now, even in our country, and it really drives me crazy, and it really kind of upsets me, in our country, we don't have a system in place to prevent big banks from failing. Well, if you read, if you see the news and saw things on TV, you know that we had a big bank fail. And now I'm concerned that maybe a global effect to that. We'll ask him about that in a little bit. But it's, again, it's very disheartening in our country to have our banks fail. Because when you talk about finances, you work hard for your money. You put it in a place where you feel it's safe. You don't want to put it underneath your mattress in your home. So you put it in a bank. Again, we'll talk about that later. Our special guest is providing personalized financial advice to individuals and families since 1986. It's awesome. So he's seen a lot. He's helped people out a lot. He's seen, he's worked with a lot of rich people, real famous people. But after a while, he realized, as he got older, he wanted to do a little second act. He wanted to fulfill a second act of his life. He needed to do more than just help rich people get richer and successful people do to our self-achievements. He needed to do other things. Without further ado, let's welcome to the show our special guest, Jeff.
Hello. Thanks for having me.
Thank you very much for joining us, sir. Like I said, it's a tough little time right now because I'm sure when you woke up and saw that this bank failed, it probably threw you back. It throws me back to the point where, how does that happen in our country? But again, like I said, we'll talk about that in a little second. Sure. Before we get to the questions, please kind of introduce yourself. Tell us more about you and your new book.
Yeah, so as you mentioned, my name is Jeff Bernier. I am the founder and president of a wealth management company in Atlanta, Georgia called Tandem Growth Financial Advisors. And I am married to my wife, Ashley. We have two great kids, a couple of grandkids, and very busy. And professionally, we help people create the clarity and confidence to live a good life through financial counseling. And after, I'm 37 years now, but 36 years of being an advisor to clients, I decided it was time to put together some thoughts that I've had for a long, long time. And so I wrote a book that came out last October called The Money and Meaning Journey, a guide to clarity, financial confidence, and joy. And really what it does, it targets people who are either late in their career or earlier in their retirement, and help them think differently about what matters most and what truly gives them joy and meaning in life. Have a little bit of a workshop that I used to do with clients called the Money and Meaning Experience in the middle part of the book. And then the last half of the book is all about how do you create the capacity, how do you create the financial means to go live your version of a meaningful life. So, and it's a very easy read. It's not really designed to be overly technical. It's just technical enough to understand where the major issues to address are. But it's designed to be kind of an easy read and a summary of a lot of other books that and resources that the reader can go deeper if they choose to.
That's wonderful. That's a great book, great help. I'm one of the ones who started out late thinking about retirement. Well, now I'm basically retired, but it's a point where growing up, didn't have very much money expertise. Came from a single household, single mother of 4 kids. We already talked about money, stuff like that. They go see you in your business. What would a person need financial-wise is sit in front of you to make it worth your while. Because, as you start, if you try to hurry up and try to accumulate things, you may not have enough money. Because, I read more retirement stuff now. You need $500,000. You need this much money. How much money they need to sit in front of Jeff and his team to make things worthwhile?
Yeah, so part of the reason I wrote the book, and part of the reason that we've become really active educators on social media platforms, is that our firm is not a good fit for a lot of people, because we do. It was similar to other firms. I determined a long time ago that we're best at doing fewer, deeper, more robust relationships. So we're not a firm that has thousands and thousands and thousands of clients. We've got fewer, more robust, deeper relationships, both in terms of uncovering and getting to know our clients, but also in the technical needs that they have. So our firm really is not appropriate to many people in terms of, to a lot of people who are not, at least have some measure of financial success. So, our typical clients are, have net worth between about $1 million and $10 million, which is not, in this country, that's affluent, right?
Yeah.
But we try to teach, and through our writing and social media and other things, to encourage. And I think what I would encourage all your listeners, regardless of your wealth, and that's really the part of the main message of the book, by the way, is your balance sheet does not define you as a person. So never let anyone, including people in my industry, say that you're not worthy because you don't meet their standard of who their typical client is. That's ridiculous. God created all of us uniquely for a purpose with value, regardless of your circumstances and even choices you made or things that have just happened that you had no control over. So never let anyone judge you by your balance sheet or your resources or even your past. And so the book is really designed to give you encouragement, but our firm is really, again, deals with people that are what I define as semi-affluent. But I think everyone can benefit from a process of uncovering what matters most and getting their actions, resources, and financial affairs in alignment with what matters most. So I don't care what you've got. Those are things that can be helpful to you. And I'm happy to report, I know we're going to talk later about some changes in the industry, but I'm happy to report there are more and more firms today that have different models than mine that can work with the mass affluent or even the young or people that don't have a whole lot of resources yet. And so our industry has really improved a lot as we moved to more of a fiduciary world as opposed to a sales culture world in the financial services industry, where there are a lot more choices. So there are firms that do great planning for people that are just starting out, or later in life that just haven't accumulated as much as they thought, and they want to pay someone an hourly fee, a couple hours or 3 hours worth of work mapping out a plan, and then they go back and see them once a year like a dentist, that have models that can serve people that don't have a lot of means. But again, I don't want to understate how important it is, the planning, regardless of what you got, of what your resources are. And then secondly, don't judge yourself or let anyone else judge you by, your balance sheet or your income.
Yeah. Well said. Thank you for sharing that. And again, I'm in my 60s now, so growing up without the internet and easy access to learning and researching stuff like that, that's one thing about the internet, where you can sit down on a Saturday, Sunday, start researching and say, okay, what can I do to improve my retirement income? Because when you get to that retirement age, or you want to sit there and start working for somebody else, you want to make sure your money's right, or what are places so you can keep on living, having that standard of living that you kind of used to, or at least paying your bills, So that's one thing I like about the internet, where you can sit and just kind of research, do what you got to do, and then when they're ready, talk to you or just ask questions online, because I know you have a statement in there where it's 6 financial challenges in retirement.
Right.
Give us some challenges in retirement that you talk about to your people.
Well, the first one is the future may not be like the past.
Yeah.
I mean, we've enjoyed a period of time where returns in being a shareholder in good businesses, being a stockholder, owning stocks or mutual funds or in businesses, has rewarded us handsomely over the last 10 or 15 years or so. And we might be in an era of lower expected returns. We may be in an era where returns are not as favorable as they were in the past. And I'll even take this longer. I mean, the United States has been pretty favored in the last century. I mean, at the turn of the century, back in the early 1900s, I mean, we were still an emerging market, if you will, in the early 1900s. So we've enjoyed a really good century in terms of economic development and growth, and there's no guarantee that the future is going to be like the past. So number one is we have to be prepared, for potentially lower expected returns than we've enjoyed in the recent past, in the last 20 years or so, because markets are not as cheap as they once were, and interest rates are lower than they have been historically. Now I know they've come up recently, but they're still very low relative to history. So number one is expected returns could be lower. Number two, and that's both in stocks and bonds. I guess that would be two different challenges. Number three is we're living longer. I mean, it's a blessing to have great health care, but we are living longer. So we're trying to retire younger, and we're living longer. So we are, we've got longer amounts of time that the capital has to last. And so while that's a good thing because we're living longer, it can be a financial challenge if we're not prepared for long life expectancy. Similarly, as I've mentioned, we've got a great healthcare system in terms of technology and resources, but it's really expensive, as you may have noticed. Yeah. And so another challenge is how do we pay for this? How do you pay for your health care? I mean, Fidelity puts out a study every year, and they analyze how much people need just to cover deductibles and coinsurance and the things that Medicare or Medicaid and health insurance doesn't pay, and it's substantial what you're likely to need over a 30-year period starting at age 60 to pay for health care. So that's a major challenge. Obviously, you talked about the banks, and the government provides some safety nets, but they're not. The government does not have the resources that it once had. I mean, if you look at Social Security alone, there are a lot more people retiring today, and demographics, and therefore there are fewer people paying in for the people that are retiring. So there is some question over the safety and security of the safety nets that we're used to, like Social Security or Medicare. And so, again, that's a danger that we have to face as we move into the retirement. And I guess the last one I'll just talk about briefly is that we've been through a lot. There always is, but it's more important today to recognize it because most of us manage our own money today. And when I say that, I mean either you or your advisor or a mutual fund company or whatever. We don't have pensions. We don't have guaranteed income like our parents and grandparents might have had working for big companies. They don't exist much anymore. So we've got to manage our own affairs. And one of the challenges of that is making behavioral mistakes with your money. We teeter between fear and greed, right? So we don't want our neighbor to do better than we did, and so we lever up portfolios and take more risk oftentimes when we shouldn't. And the flip side of that is, when things are difficult, we sell and ask questions later, And so as we're managing our own money, the final thing I was going to highlight is just we've been through, the tech bubble bursting in the early 2000s. We had the Great Recession in 2007, 2009 with the banking, a significant banking and financial crisis. And then, of course, we had the COVID issue, recently. And so a lot of people have made behavioral mistakes with their money that they may never recover from. Mm-hmm. And so as you and I have to manage more of our resources on our own, behavioral mistakes and investing rationally is really important, and that's a danger, I think, as we move into retirement.
So much great information there, great tips. I hope people are listening and take some stuff out of that. Before we get to the next question, please tell us where do we go after this show, learn more about your book and yourself.
Well, thanks for asking that. So the book I have has a website, and it's just jeffbernier.author.com. So JEFFBERNIER author.com. You can also find the book on Amazon and all the major retailers. So that's where you can find the book and more about me and the concepts in the book, and some bonus material if you choose to buy the book that you might find helpful. Matter of fact, the workbook from the workshop that I used to do that's part of the book, there's actually a workbook that you can download on that website as well that you might find helpful, as well as tons of other resources. And then our corporate website is tandemgrowth.com. So tandem like the bicycle, TANDEM growth.com, and you can find me and our firm there as well as jeffbernierauthor.com related to the book.
Outstanding. Okay, so we get to that retirement age, we kind of stop working for other people, and that's, to me, that's why I can say I'm not going to stop working, even though I'm, quote, retired. I'm going to do consulting stuff and this and that for myself. Now, give us some strategies for income when you're in the retirement. Can you give us a couple of strategies that how we can do that, how we can make some, more money coming in instead of money going out? How can we do that?
Yeah. Before I do that, though, let me just talk about what you just said about things that you're doing. So I think for many of us, traditional retirement is dangerous. So you've got to find. I heard someone once said, we've got to have enough means to sleep at night, enough money so we can sleep at night, and enough reason to get up every day. So you gotta have purpose, whether it's for a paycheck or grandchildren or you've got to have something to get up and do. And for people that don't have enough, human capital is really important, and so it's really important to find things you love to do and you can serve other people, and you can get what I heard a speaker say once. You can get certificates of appreciation, which is $1. You get paid. So anyway, so I don't want to go into income strategies without just acknowledging that creating income later in life, doing things you love to do is and continue to develop your own capability is regardless of your age. I just heard a speaker who's 85 years old that is contributing, and he doesn't need the money. All the income from it's going to charity, but it's interesting and neat. So anyway, let me get to the specifics of your question. So the first thing I would caution your listener is as you build investments or you build financial capital, I want to caution you from going from thinking that you need yield in retirement. I think one of the biggest mistakes people make in retirement is they search for yield. In other words, higher yield, higher interest, higher dividends, because there's no free lunch. And things that have higher yields usually have more risk. That's why they have higher yields. They have to have higher yields in order to attract capital. So I would want your listener to think in terms, as they move into retirement, more of a total return approach. So it doesn't really matter if the return comes as dividends, interest, capital gains, human capital, as we already mentioned, your own labor. What really matters is the total return. And so as we build strategies, what we're trying to do is make sure that our clients have the income that they need from total return. Now, if you do this properly, there will be yield. There'll be dividends. There'll be interest. There'll be capital gains. But so I think when you move into retirement, what we tend to get our clients to do, or we think is helpful, is to think about really buckets of capital. So you need money that's short-term, safe and liquid for short-term needs, right? Your air conditioner blows up and you've got to replace it, and it may cost you a few $1,000s. You don't want to have to sell long-term assets at a bad time to do that. So you need emergency reserve capital. And then the second bucket of capital I think is probably the most important, and this is where your actual spending income will come from, and that's what I call a short-term portfolio. So what we like to do is have our clients have 2 to 3 years worth of distributions sitting basically in safe liquid investments. And I still believe FDIC insurance is important. So if you're spending, $3,000 a month from the portfolio, that's $36,000 over a 12-month period. 2 years of that would be worth $72,000. So I'd keep at least $72,000 in that example in a short-term account, and once a month you're getting income from that account. You're taking the $3,000 a month out of that account, and so you're spending this short-term portfolio account. And then the third bucket is your long-term portfolio, which you broadly diversify it between stocks and bonds and large companies and small companies and international companies, maybe some real estate securities. If you are a business owner, your business would be considered part of your long-term. And once a year, you're replenishing the short term. And again, as I mentioned, in the long term, in that final bucket, again, I'm fairly agnostic on whether it was dividends, interest, capital gains, because what happens if we just look for things that pay a high dividend? Right now, people are starving for yield, so the things that pay the highest dividends, they're popular. And when things are popular, that means that they're expensive. And when they're expensive, that means they have lower expected returns because you're paying a high price for them. So I wouldn't just say I want high dividend paying stocks. Same with bonds. If you get a bond, which is basically a loan, you've loaned the money to somebody, either the government or a company. If you get a high yield, the reason you're getting the high yield is because they have lower credit quality. The only way to get higher yield is lower credit quality, which is risky, which means, they could become SVB Bank, and if you loan money to SVB Bank, you've got wallpaper now. It's worthless. Your bonds are worthless. Now, if you had money on deposit at the bank as a saver, you're okay. But if you loan the bank the money, you're a bondholder, or you bought stock in the bank, you don't have it anymore. And so that's what happens when people reach for yield, is they buy lower quality things. So this is not maybe a satisfying answer, but I believe as you try to generate income at retirement, again, my most important takeaway is think in terms of total return and be thoughtful about how you're spending your capital. Now, when you're spending out of that short-term portfolio, you still got to make sure that you're not spending more than the portfolio will support over a 30-year period with reasonable expected returns and reasonable inflation assumptions.
Well, hey Jeff, I hear you talk about the dividends. I hear you talk about stocks and bonds. Haven't heard you say anything about gold and silver. I'm getting bombarded with the gold and silver. Real quickly, what's your thoughts on investing in gold and silver?
So we're not big fans of tangible things like that.
Okay.
To me, they seem more speculative in nature because you'll only make money if someone pays you more for them in the future. In other words, it's not like a business that has profits and losses and earnings. You're buying it because you hope at some point in the future someone will pay you more for it. So as a general principle, we don't tend to recommend things like gold and silver. Now, gold and silver and things like that, in periods of high uncertainty, they do get a bid. I mean, they do go up sometimes when there's a lot of uncertainty in the marketplace. But most people view them or they own them because they think they're inflation hedges. And the data shows that over long periods of time, they've not proven to be great inflation hedges. Owning great businesses has been a better hedge against inflation. However, my final comment on this is if anyone felt really strongly about it, I wouldn't I wouldn't try to talk them out of it if they felt really strongly about it. You just need to size the allocation,
right,
so that it doesn't blow up your plan. If because I have a lot more confidence in the compounding ability of the world's great businesses, quite frankly, which have if you own stocks in companies, they have commodities, they have plant, they have equipment, they have patents. Heck, if they're a manufacturing company, they have inventory that is tangible. They have real estate. So these businesses have hard assets on their balance sheets. But we're not. The long answer is we're not big proponents of loading up on gold and silver as a long-term investment.
Okay, that clarifies that. Thank you. Okay, so we're into that retirement stuff, and one of your things that you mentioned on your bio stuff is 2023 investing strategies. We're ready to get close to the end of the show, so we don't want you to go too deep into it, but give us a couple of teasers about strategies for 2023. I mean, because again, like you said, our country is doing okay. We've done some great things. What's 2023 look like?
Yeah, so this is every investment firm has to have some pithy headline to try to get some eyeballs, right? And what I'm about to tell you is going to be really boring because our 2023 strategies are not significantly different than our 2022 strategies, and our 2024 strategies are likely to be, because there are long-term principles that work all the time, over time, if you give them enough time. And 2023 is no different. But what I would say about 2023, which might be a little more satisfying to your listener, is that there are places in the market that are cheaper that have higher expected returns because they're cheaper. Now, most people aren't going to want them because their trailing results aren't very good. That's why they're cheap. So right now, value strategies are more attractive than growth strategies because they're cheap relative to their earnings and have more compounding ability because you're getting them at lower prices. So strategies that have lower price to earnings or price to book or price to cash flow, pick a metric on what's cheap. The other one I would say is international relative to U.S. International markets have higher. I just told you not to pay attention to yield, and I'm about to say they have higher yields. But the reason they have higher yields is they have lower prices. So the international markets have attractive valuations, and emerging markets have attractive valuations relative to U.S., and therefore they have higher expected returns. And not only that, markets are cyclical. I mean, all of these risk-based assets have similar expected returns over long periods of time, but they perform differently in different environments. And we've had a 10 or 15-year period where U.S. equities have done a whole lot, U.S. stocks have done a whole lot better than international stocks. But that's not true over the last 50 years. I mean, over the last 50 years, international has won slightly more, on decades, has likely won slightly more than U.S., but it goes back and forth. So my point for 2023 would be, don't ignore international, don't ignore value, and so those are areas of opportunity, I guess I would say, and that's what I'll say about the noise going on. I mean, people today might be looking at their 401k statement and saying, I don't want any of those bonds. I thought they were safe, and bonds were down, 13 or 14% last year. Quality bonds, safe bonds were down 13 because of interest rate changes. So people may be looking at their 401k statement and saying, I don't want any of those. I thought that was my safety. I might as well just own stocks. I would caution investors from giving up on having a diversified portfolio of both stocks and bonds. So I guess my best idea for 2023 is maintain a balanced portfolio and rebalance back into those things, because the expected return on bonds is higher today than it's been in a long, long time. I mean, a year ago, quality bonds were yielding 1.5%, and now they're yielding 5.5%. So the expected return on your portfolio and on those bonds has gone up significantly. So don't give up on them. Right at the time where we might be, we might have a recession. We might be in it now, for all I know. I mean, they won't tell us, statistics won't tell us till later. And the last thing you want to do is give up on fixed income securities, high-quality fixed income securities in a recession, because they tend to do better than stocks. So I don't know if that was very helpful or satisfying, but that's what I got for 2023.
That's wonderful. We get the point of listeners out there too is we get so jealous because the knowledge is unbelievable. What you talk and you speak great stuff, and some of us just cannot aren't having the ability to sit in front of you. So we're very happy to have you on the show. So we're definitely going to promote this and get it out there because we don't want to get you some business, because it's so important to have a person like yourself in your company in your corner. So many things you can learn, and so many things can help you, and to get to that next level, get to the second act. So I'm so pleased and honored to have you on this show, so you can sit there and just give us that knowledge that you've given us. We thank you so much for that, because it's just amazing. It just blows my mind to hear you speak about stuff that, like I said again, as a person growing up with a single mom, 4 kids, never talked about money. We never sat down at the table and said, okay, this and that, and stocks and bonds. Never did that. I started learning about how things work later on in life. I'm still not where I want to, go ahead, sir.
Yeah, I do. Well, you flatter me, first of all. You're very kind. But secondly, I'll say none of us talked about it. Most of us didn't talk about it around the dinner. I mean, money is like taboo. You don't talk about money. You don't. I mean, so and we probably grew up in a generation where our parents were very private. They didn't share. Right. I mean, today we share everything with everybody. Back then our parents. I mean, you just never know.
Right.
So I certainly understand where you're coming from on that.
All right, before we get to the final comment and closing, please tell us again, where do we go to learn more about Jeff, your book, and your wonderful, wonderful business?
Well, thank you so much, Hollis. So, the best place is jeffbernierauthor.com, jeffbernierauthor.com for the book and information about me in the book and some other resources. And then tandemgrowth.com is our corporate website where and I have a podcast as well. You can check it out on both. You can find it on both sites. And I'm on social media and Twitter and LinkedIn and Facebook and all those places too. At least the firm is Tandem Growth. Is if you just look it up, you'll be able to find it. So those are the best places to find me.
Outstanding. Final comment. When you and your wife give it up, close the doors for good, years from now, what would Jeff like to be remembered for professionally in closing?
Well, I mean, to me, I try to live an integrated life so that my professional life and my personal life are the same. I'd like to be the same person in my working day as I am at home. And so I think probably the best answer is I just want to be a good steward. I mean, we're in a business where we manage other people's capital, so I want to be a good steward of other people's capital, and I want to be a good steward personally of the resources I've been blessed with and my experiences and what I've learned. So I think the best answer is I just want to be known as a good steward of both client resources as well as the gifts that I've been given.
Outstanding. Just as we learned today, you are a great steward, and we're just so honored to have you on the show today. You have a great, great weekend, rest of your week. I'd love to have you back in a few months to see how everything's going, see if we're adjusted, see if we got, we're on the right trail, and we can kiss this gold and silver people goodbye. But thank you so much, sir, and we'll talk to you real soon.
It was my pleasure, Olive. Thanks for having me.
All right, bye-bye. All right, guys, you have questions, please follow up with Jeff. Like I said, we always have great guests, okay? So please follow up. Make them feel love. I mean, he's doing great things for us. Get his new book, The Money, The Meaning, Journey, A Guide to Clarity. Okay, we need that. The retirement age, confusing. And like you were saying, Medicare and Social Security. We can't depend on Social Security. Social Security only takes up like 30% of your income. So what do you do for the other 70%? What are you doing? Okay, so we got to think about that, all right? We love to thank you, Jeff, for coming on. It was great, great stuff. I mean, again, so much technical stuff there that can kind of blow my mind, but stuff we don't know. But follow up with Jeff, okay? Hey, guys, thanks for joining us today. Show went kind of long, but an important show. We'll be back tomorrow. Our special guest is Paula. So she'll be talking tomorrow, too, about her new book. So let's close the show. A little song. Thank you, everyone, for joining us. Make sure you follow up with Jeff. Great stuff. And join us tomorrow, 10 o'clock, Mountain Standard Time. Our special guest, Paula. As always, I'll see you next time.